When discussing financials with capital seekers and preparing the financials for the capital raising process, we generally get to the subject of distinguishing between fixed cost and variable cost. It is important to know this because it conveys some very important information to investors. First of all, let's talk about what fixed and variable costs are. Fixed costs are just as the name implies, expenses that are fixed and are generally the same no matter what the level of business is, whether it's a good month or a bad month. The rent is going to be an example of a fixed cost, and also management salaries is an example of fixed cost. Variable costs, as its name also implies, are costs that are variable with the level of business in a company. Examples might be salesperson's commission, because this is a cost you don't incur until a sale is made, or if a company makes sales on credit cards, the merchant fees that a credit card company charges are not incurred until that sale is made. The distinction between fixed cost and variable cost are important because it helps investors to determine two very important financial ratios when evaluating a company, the burn rate and the break-even point. The recommendation I always make to capital seekers is if you do not feel comfortable categorizing your costs between fixed and variable, give us a call at the Capital MatchPoint. We deal with this a lot across a lot of different industries, and we'll be happy to help because at the end of the day, we're in the business of maximizing the opportunities of capital seekers to get that funding they need.